All right, David, let's get right into it. We've been talking a lot about what to do with cash, especially treasuries, but, there's a question I hear all the time from people who are just sitting on the sidelines with their money.
And that question is pretty simple. Look, why should I bother with a 4-week T-bill auction when I can just dump my money into a money market fund? It's a fantastic question, and it really cuts to the chase of what these funds are all about, doesn't it?
It absolutely is, Mark. And the answer really boils down to one word: convenience. We're talking about the ultimate convenience play here. This is for anyone who wants a decent yield on their cash, but, doesn't want all the headache that can come with managing it.
So, let's break that down. What exactly is a money market fund? Well, think of it just like a mutual fund. The big difference? Instead of buying stocks, this fund goes out and buys a whole bunch of really high-quality, super short-term debt instruments on your behalf.
Right, so a fund manager is doing all the heavy lifting. They're buying things like U.S. Treasury bills, which we've talked about. They're also buying something called commercial paper. That's basically a short-term IOU from a big, stable company. And they're buying large CDs from banks. So you get this nice, diversified mix of what's considered some of the safest, most easily accessible debt you can find.
And all of that leads us to the number one advantage, the real killer feature here: same-day liquidity. Think about it. When you buy a treasury at auction, your cash is locked in for a set period. With a money market fund, nope. You can sell your shares and get your cash back in your account ready to go on the very same day.
Exactly. And if you're using a big brokerage like Schwab, this whole process is just seamless. You'll see these ticker symbols, right? Things like SWXX, that's a prime money market fund, or maybe SNXX, which is one that only holds treasuries. It's literally one click. Your cash goes from earning basically nothing in your settlement account to earning a pretty competitive rate. Just like that.
Okay, and this is where we have to pump the brakes a little bit. There's a crucial point that a lot of people, especially those new to this, tend to overlook. I kind of call it the stable dollar myth. There's this assumption of total safety, but that's not exactly the whole picture.
See, the main goal of almost every one of these funds is to keep its share price, what's called the net asset value, or NAV, pegged at exactly $1. So you put $1,000 in, you get 1,000 shares. The idea is for it to feel just as solid and stable as cash in the bank.
But, and I really want to stress this, it is not a bank account. A regular savings account has that FDIC insurance, right? You're covered up to $250,000. A money market fund, on the other hand, is an investment. And that means it is not FDIC insured. That right there is the fundamental difference in risk we're talking about.
Now look, it is incredibly rare. We're talking about something that only happens in times of really severe financial crisis. But it is technically possible for the stuff inside the fund to lose value. And if the whole market just hits a brick wall, that $1 share price can, well, it can break the buck. That's the term for it. It might dip to, say, 99 cents. It's a tiny loss, yeah, but it completely shatters that idea that it's perfectly safe, like cash.
Okay, so that risk, however small, is part of the deal. But it's not the only thing to consider. The other side of the coin is the cost, because all that convenience we talked about, it isn't free. So let's get into the nitty-gritty of the fees and taxes you've got to watch out for.
So the big one you need to know about is the expense ratio. It's pretty simple. It's the annual fee that the fund charges you for doing all that management work. The sneaky thing is, you don't really get a bill for it. It's just taken right out of the fund's assets, which means it quietly eats into your overall return.
So what are we talking about here? A pretty typical fee might be somewhere around, say, 0.35%. To put that in perspective, if you've got 10 grand parked in the fund, that's about $35 a year you're paying for that management.
And at the end of the day, that's exactly what you're paying for. It's the price of convenience. It's a relatively small fee to have someone else do all the work of building and managing a complex ladder of T-bills and CDs for you.
That's it exactly. And right alongside fees, you absolutely cannot ignore the taxes. This is a super important detail. So with a standard fund, like that SWVXX we mentioned, the interest you make is going to get taxed by both the federal government and your state. But if you live in a state with high income taxes, this is where a treasury-only fund like SNSX can be a huge deal. Why? Because the interest you earn from U.S. Treasuries is almost always exempt from state and local taxes. That can make a big difference.
All right, so let's pull all these threads together. You've got the incredible liquidity, you've got that small but real risk, and you've got the fees and taxes.
When you look at the whole package, you really start to see what this tool is designed for. So, does that make it the perfect parking lot for your cash?
You know, I've always thought of it as the lazy man's treasury. And I mean that in the best way possible. You get pretty much all the benefits of holding short-term government debt, but you get that instant liquidity, and you have to do absolutely none of the work yourself.
So if we're going to boil it down, the key takeaways are simple. First, the liquidity is off the charts, which makes these funds a fantastic spot for something like a big emergency fund. But second, you've got to pay attention. You have to watch those expense ratios and really understand how the taxes are going to work for you. That's spot on, Mark. This is not a long-term growth investment. It's a strategic holding pen. It's a place to park your cash when it's just waiting on the sidelines for you to make your next big move, all while it's earning a respectable yield.
And that really brings us to the final question, the one you need to be asking yourself right now. After looking at the liquidity, the risk, the fees, and the taxes, take a look at your own portfolio. Is your cash sitting in the right parking lot?